Hello and welcome to the Chamber Music Mindset. I am Anna Rathman, your host and CEO of Granadilla Advisory. Welcome to this week's video. As always, I have to remind you that nothing you hear in this video is investment advice and is really for your information purposes only. It's for your own edification and so that we can understand what is happening around us. Okay, let's start with the market performance. We have a lot to cover today. S&P actually came back with a positive return for the week. It had a negative Friday, kind of like the week before. It even reached an all-time high on Thursday, but it was really Friday that took everything down. What happened Friday? We had that inflation print, which we can talk about a little bit later when we get into the data. And that inflation print was actually PCE, the Fed's favorite gauge of inflation. And I know everybody's waiting to see what the Fed is going to do in September. It's highly anticipated, and we are expected to see the Fed cut rates by 25 basis points. There is a real possibility they might not, in which case the market is expected to react not so positively. There was also some consumer sentiment data that came in Friday that the markets didn't like, and we can talk about that a little bit later in addition to some of the stock earnings reports. Last week, I did mention that we were going to get the Nvidia earnings, and we did. The pre-market futures were down because the market or investors expect something extraordinary from their favorite names. For a long time, many years ago, it used to be Apple. It didn't matter how much they beat earnings by, the stock always went down. The expectations were so high. It was sort of like sell now and let's digest this report later. That seems to be sort of what was happening, especially in the pre-market for Nvidia. They gave us good earnings year over year. It was 56% revenue growth. Any other company would be just so proud of that. But for Nvidia, it was less than what investors expected them to outperform by, because that amazing outperformance has been priced into the stock. They also gave us a little bit of a lackluster guidance, and it was signaling a bit of a slowdown in that AI demand. What did we think was going to happen? That we were going to be buying AI chips until the cows came home? It was always going to reach some kind of a plateau. The plateau isn't here. It is the rate of increase is starting to show a little bit of slowing down. It's really okay. This really should have been expected. We just didn't know when, right? So the markets didn't like that as much. We didn't get as much information about China, but it's really okay because the earnings didn't include any H20 chip sales to China because they weren't allowed to at that time. So in some ways, what was priced into the stock when that news came out was really forward-looking, but it had nothing to do with these earnings. So it was understandable. They're forward-looking, their most advanced Blackwell chips. There still seems to be a lot of really great demand for those chips, which means AI development is alive and well. So nothing to really worry about. In fact, they have so much cash on hand that they decided to use about $60 billion to buy back their stocks, because the question is, where are they going to put that cash? If it were a dividend-paying company, it would give you more dividend, or they would, increase dividends, but it's not, right? It's not a dividend grower. So it makes sense that it would put some of that cash into work by buying back some of those stocks. Now, AI revolution, it's still alive and well. And all of that money that is chasing Nvidia and all of that hope for AI investment, so far it has been seen in stock prices. For a while there, it was all of Mac 7s. And then even among Mac 7 names, there were some winners and losers. And Nvidia, because it's selling, picks and shovels, it was actually doing really well at the forefront of that AI run. Now, what we found was that some of that AI investment that the companies are spending a lot of money on that we're hearing about, it's now showing up in the government data. It showed up in the GDP. So I'm going to talk about GDP a little bit later, but I do want to point this out that GDP growth for the second quarter on an annualized basis went from 3% on the first estimate to the second estimate of 3.3%. And that gain really was had in the business investment portion of the GDP calculation. That's AI spending. So we're really seeing the impact of AI investment in the boots on the ground in the GDP calculation, which is where it impacts all of us. So I did want to point that out because I think this is where sort of the fundamental data meets the stock market, and they don't always meet. You've heard the saying that the stock market is not the economy and the economy is not the stock market. It's true. And it's not always that you see that intersection, but we saw it last week, so I needed to point that out to my listeners. Okay, so today's topic is stagflation. And I picked this topic because there are some data points that are relevant to this topic, and also it's a word that's being thrown around left and right. I started hearing this term about 2 years ago. And, it came and went. And now with the tariffs, it's coming. It's appearing more and more. I'm seeing it more and more. And so I do think that I need to address it. So let's start with what is stagflation. It's basically a combination of three different things happening at the same time. One is stagflation. That's stagnation. Economic stagnation. That's the stag part of stagflation. High inflation, that's the inflation part of stagflation, and high unemployment. And the reason why these three things are put together is because we saw it in the 1970s. We had an oil price shock that actually took prices through the roof. We also had a supply chain disruption. We also had an accommodative monetary policy that wasn't helping the situation, right? But a lot of things were happening where we can't put a finger on exactly this was the culprit. In fact, that was also the decade that saw the US dollar come off the gold standard. So the currency was up and down. And inflation is an issue of currency, right? So it was a very turbulent time. It was not a happy time for the US economy. And it was also a bad situation, something we don't want to repeat, because it ties the hands of the Fed. What do I mean by that? In an inflationary environment, the Fed needs to keep rates high. In fact, that is the environment that we have been in since 2022. The Fed started to raise rates because inflation was having a hard time coming back down from a very, very lofty level, right? Now, if the Fed keeps rates high, that keeps economic activity at bay. In fact, it is not conducive to growth. It doesn't cause recession per se, but it's not helpful. It's not moving in the same direction as economic growth. But what if you have a stagnation, economic stagnation? High rates aren't going to help you. So basically, the Fed doesn't have a tool, a blunt tool like interest rates or QE or QT, that will quantitative easing, quantitative tightening, jargon, that actually one thing that will help with both situations. A medicine for one situation is actually poison for the other and vice versa, right? So it ties the hands of the Fed. So we do not want to be in that situation. So the question is, are we in a stagflationary environment? It's not a simple answer. So the first question I have is when someone will say that, well, okay, what is the time frame in which we have to have those three elements to call it a stagflation? Is there a definition to it? I don't think so. Is it a year? Is it 2 years? And it's my opinion that when you're in something, you don't know that you're in it, right? Because at any given time, you might have a weak labor market, but maybe inflation is low or high. Weak labor market inflation is high and growth seems to be stagnating. but that can actually turn around the next month, right? In the short period of time that I've been doing these videos for you, we've seen data go up and down, up and down. So while you're in it, it's actually pretty confusing. It's hard to say you're in stagflation. So that's one thing. And secondly, let's take a look at the recent data. I just said that GDP came in at 3.3% annualized for second quarter. That's not too shabby. I wouldn't call that a stagnation, especially because before the pandemic, we were barely getting to 2. If we got to 2% annualized, woohoo, let's have a party. We're at 3.3. AI driven or not, that's a pretty good number. Inflation, core PCE came at 2.9%, headline at 2.6%. Now, is that on its way up? No, it actually came down to that level, and it's been between 2.5 and 3 for a while now. Okay, so the inflation rate itself has been very stable. Okay, I wouldn't call that like a huge inflationary environment like the ones that we saw in the 70s. And the other point is that the unemployment part. At 4.2%, and we'll see what the labor market data say on Friday, we're expecting it to be 4.3. That's near historic lows. Okay, so we're not talking about a high unemployment situation. So if we're strictly looking at the data, that's not where we are at the moment. Why I think people utter these things? I think it's because it's out of fear. We're afraid that we're heading into one. We're afraid that there's going to be economic stagnation. We're afraid that the labor market is slowing down. I mean, we know it's slowing down from the data, but it will slow down to the point where unemployment rate will go up to levels that are really detrimental to our society. And we're afraid that inflation due to tariffs will continue to go up and up and up. The fact that we're talking about the word stagflation tells me that there's a lot of fear out there. And my response to that is don't react with emotion. Deal with the reality around you, but don't react to this emotion, because what happens is that there is this self-fulfilling prophecy aspect to the economy, because all of us are psychological creatures. So if we hear words like stagflation and understand what it means, then we end up changing our behavior to counter it. Why counter something that isn't here at this time, right? That's the self-fulfilling prophecy of it. It impacts our decision-making process and where we spend money, how we spend money, whether or not we do things that we need to do or want to do. It really has an impact on our quality of life. So react to the reality around you and your personal situation, but don't react to these words, because when it's all over the place, I get a little nervous that it'll impact our psychological well-being. On top of that, this might be temporary. Over the weekend, we heard that India is getting rid of their tariffs on U.S. goods. Now, I would like to see them buy less of Russian oil, because I think that is at the center of why we increased tariffs on India. But that is a gesture that is heading toward a negotiation. All of these high tariffs can go down if they're negotiated enough. Okay, so that is the temporary nature of the current tariff situation. The other thing is the constitutionality of these tariffs is being challenged. In May, it was challenged, said that these tariffs were illegal. Over the weekend, we just heard that these things are illegal. The appeals court upheld it. Now, the way it upheld it was that it was not legal for the Trump administration to utilize something called the International Emergency Economic Powers Act to levy these tariffs. But frankly, there are other ways that the Trump administration can keep these tariffs. So we'll see. But I should tell you my opinion. My opinion is that we need to really have a serious conversation about the constitutionality of these tariffs, because these tariffs are taxes. And the only body in Washington that has the power to tax unilaterally the way it has been done is Congress. And this has not gone through Congress, right? So Even if it's not through the courts, it'll probably be through the courts. But even if not, we need to really have an honest conversation about this, because this isn't just like, let's protect this industry, we're going to put a tariff on it. Let's protect this, area of our economy, let's put a tariff on it. This is a blanket tariff. We'll see where it ends up. Maybe this all goes away or comes down to a reasonable level, because everything gets negotiated. That would be the best case scenario under these circumstances. But the point here is that this could be temporary. So don't let terms like stagflation impact your emotional well-being. Okay, now I'm going to talk about what to expect in this short week. But before I go there, I want to talk about consumers again, you and me. Earlier, I said that there was some consumer sentiment information that came in Friday that didn't help with the whole, inflation number that was higher than 2%. And that was University of Michigan consumer sentiment. It fell from 58.6 to 58.2. I'm not surprised it's falling because prices are high, and labor market, the numbers are not coming in super, healthy. So of course, if you worry about not only your ability to purchase things in terms of your purchasing power, but also income and cash flow, that tends to do a number on our sentiment. So not too surprised. But I do want to tie this to earnings here. Burlington Coat Factory. I know it's a chain. It's all over the country. It is. There's one here in Ohio that I know of. It is a discount store. And they reported earnings last week, and shares went up as much as 9% in that same day. Second quarter results topped estimates. The guidance for rest of 2025 was upgraded. It's doing really well. They're very, very happy. This was reminiscent of what we talked about last week with regards to Walmart and how these stores that cater to, providing discounts is doing really, really well. This tells us, along with the consumer sentiment that actually came down from the month prior, tells us that, again, the consumers are looking for ways to stretch their dollar, looking for ways to maintain or retain their purchasing power of what they bring home. They're looking for deals and they're looking for value. Okay, this is okay. That's okay. I mean, who doesn't like a deal? Who doesn't like, good value? But when we do this en masse, as a, in the millions of people in the United States, I have to stop and think and take a pulse temperature of the entire economy, because it is really consumer driven. I mean, we are a consumer driven society. So the health, emotional health, we talked about that earlier, as well as economic health of our consumers is really important. I'm happy for Burlington that they've done so well, and they are looking for toward a really profitable 2025. That's wonderful for them, but that says something about us. Again, it's the same message as last week when we talked about Walmart. It says something about us. It says something about how we feel. With the sentiment going down, all of these things are lining up. The earnings, what we're learning from those earnings reports, lining up with the fundamental economic data, then the message becomes even more powerful. And these are the moments where the S&P 500 feels like the economy, because it is telling us something about the economy. Okay, quickly, what to expect this coming week. Do you remember ISM, PMI? I know these are a lot of letters. ISM is Institute for Supply Management. PMI is Purchasing Managers Index. This is basically a gauge to see, are we growing or are we contracting as an economy? Next week, we're getting both manufacturing and services. We're a more service-oriented economy, so that's going to be very important to watch. But tariffs are hitting manufacturing. Tariffs are hitting goods, so that's also to watch. Manufacturing was contracting last month at 48. That made the stock market sell off. And employment was also below zero. So the employment gauge as well as the overall gauge was at 48. New orders was also below 50, contracting. Anything below is contracting, above is expanding, right? New orders is a forward-looking indicator because you place orders before you buy them, receive them, pay for them, right? So it fell. Prices paid continues to go up in the mid 60s. So if 50 is the demarcation of neutral, it's like 15 above. So this is not necessarily good news. And unfortunately, on the services side of ISM PMI, it's the same. So manufacturing and services both showing the same kind of pattern where employment is not doing well. New orders isn't doing well, but prices continue to go up. We'll see what it actually comes out to be. And finally, a really important day, Friday, September, what is it? 1, 2, 3, 4, 5. September 5th on Friday is Bureau of Labor Statistics giving us the jobs numbers and labor market data from August. This is the last BLS jobs data before the Fed meets for their monetary policy in September. So it's a really, really important number. It will move the markets one way or another if it disappoints or not. The expectation is pretty low. The expectation is around 70,000 jobs gained. Normally, we're at six figures somewhere, 150 or 200,000. I mean, that's a good month. But because last month was so low, it was a little over 70,000, we're also expecting around the same. We also have other job numbers that we all look at. ADP is coming up with their employment data, as well as JOLTS, which is the job openings data. It's a very important week for the labor market. And again, the last, big week for the labor market before the Fed meets. So like I said last week, I feel like every week is an important week. This week certainly is. So we'll meet next week and I'll let you know what we find out and what we learn. And so have a wonderful short week and I'll see you next week.